Recently, the political and economic world was shaken by a bombshell announcement from U.S. President Donald Trump, a 100% tariff on all imports from China, set to take effect on November 1st, 2025 or sooner.
Just want to confirm, have you canceled your meeting with President Xi? And
No, I haven't canceled, but I don't know that we're going to have it.
If Washington deems China's actions provocative. The declaration made between October 10th and 11 instantly became the epicenter of a cascading reaction across global financial markets, European political circles, and international relations. China was quick to respond, denouncing the move as a violation of trade norms and warning of retaliatory measures should the U.S. follow through. For the European Union, this was more than just a statement aimed at Beijing. It was a warning if Washington could impose a 100% tariff on a strategic tech producer like China, then no partner economy, particularly those in Europe, could consider itself off limits. Trump had already threatened tariffs on EU goods, and the strike against China served as a stark reminder any nation deeply enmeshed in the U.S. trade orbit could find itself in the crosshairs. The pressing question now is whether this tariff salvo might nudge the EU closer to China, willingly or not. Before asking whether the EU might pivot toward China, we must understand the depth of interconnection among the three economic power centers, Washington, Brussels, and Beijing. The ties are so intricate that a single tariff decision from the U.S. can reverberate across the entire global trade system. On the surface, the numbers paint a simple story. The U.S. runs a hefty trade deficit with Europe. In 2024, Eurostat reports the EU exported 531.6 billion euros in goods to the U.S., while American exports to Europe amounted to 333.4 billion euros, leaving a 198.2 billion euros gap. This is precisely the figure Trump often cites to argue that Europe takes advantage of America. But expand the lens to services and the narrative flips. According to the U.S. Bureau of Economic Analysis in 2024, the U.S. exported $294.7 billion in services to the EU, while importing $206.1 billion, resulting in a surplus of $88.6 billion. These services finance technology, intellectual property, and professional consulting are areas where the U.S. dominates. Combined goods and services, and the overall trade balance shrinks to roughly 50 billion euros, far below Trump's dramatic portrayal. Many European experts feel misunderstood. Trump evaluates economies through a production-centric lens, while the U.S.-EU relationship has evolved into a service-driven era where value lies in intellectual property patents and expertise, not just steel or cars. If the U.S.-EU dynamic is a long-married couple full of disputes, EU-China ties resemble a dangerous but inescapable affair. In 2024, the EU imported 627 billion euros in goods from China, exporting only 321 billion euros in return, creating a 305 billion euros deficit, the highest since the establishment of modern trade relations. China is more than a manufacturing partner. It sits at the heart of strategic tech supply chains, lithium batteries, rare earth minerals, EV components, and low-end semiconductors, all traceable back to Beijing. Brussels understands this intimately. EU strategy articulated by Commission President Ursula von der Leyen has shifted from decoupling to de-risking, mitigating risk without severing economic channels. The de-risking approach reflects a reality: Europe cannot overnight cut China out of its industrial ecosystem, from chemicals and batteries to solar panels, textiles, and electronics. At the same time, Brussels does not want to become hostage to supply chains dominated by Beijing. Today, the U.S. and EU together form the world's largest bilateral trade partnership when accounting for goods, services, and investment. Meanwhile, China is Europe's top goods supplier. This creates a triangular web in which any shift at one corner sends tremors through the others. In short, Trump is not merely confronting China. He is shaking the entire global trade architecture, with the EU as its most vulnerable link, dependent on U.S. markets, yet unable to disentangle from Chinese supply chains. When Donald Trump returned to the White House in early 2025, the world understood immediately America First was back, and this time harder, sharper, more uncompromising. If his first term was a prelude punctuated by the tariff battles of 2018-2020, his second term transformed trade policy into a strategic weapon aimed at reshaping the global economic order, with the U.S. at the center. Early in 2025, he openly criticized the European Union, claiming that the EU treats America worse than China, while hinting at a flat 10–15% tariff on all European imports. On September 10, 2025, in a virtual meeting with EU officials, he demanded that Europe impose a 100% tariff on Chinese and Indian goods, accusing the two nations of exploiting the European market to evade U.S. taxes. According to Reuters and The Guardian, this marked the first time a U.S. president publicly demanded EU parity, a test of economic loyalty within the G7. In Brussels, however, the call was perceived as an ultimatum. China and India are not only major trade partners, they represent the EU's most dynamic growth markets, accounting for over 22% of trade outside the bloc. French President Emmanuel Macron responded firmly, "No one dictates how Europe trades with the world." German Chancellor Olaf Scholz remained silent, though Berlin reportedly instructed ministers to avoid any statements supporting U.S.-style tariffs. The stage was set for a looming trade confrontation. Just 1 month later, the strike landed. On October 11, 2025, Trump signed an executive order imposing a 100% tariff on all Chinese imports, the highest in U.S.-China trade history. Beijing swiftly condemned the move as a violation of free trade principles and threatened retaliation, including curbs on rare earths, tungsten, and other strategic metals materials critical to both U.S. and European industries. Within 2 days, rare metal prices surged 27%. The Shanghai Composite dropped over 4%, and both the euro and yuan weakened against the dollar as capital flowed to New York. Multinationals like Volkswagen, BASF, and Apple saw share prices fall amid fears of disrupted global supply chains. Trump envisions a new bipolar order, the U.S. at the sole axis of the West Europe, left with only two choices: comply or be sidelined. Yet Europe in 2025 is not Europe in 2018. Past tariff battles and the 2022 energy shock have taught EU leaders that reliance on Washington can be as perilous as dependence on Beijing. Polish Prime Minister Donald Tusk warned a trade war with the U.S. would be a serious mistake, and all measures should be taken to prevent it. The first and most visible impact fell on manufacturing, the backbone of Europe's economy. Eurostat reports that in 2024, the EU exported over 532 billion euros in goods to the U.S., with pharmaceuticals, machinery, automobiles, electronics, and chemicals making up 60% of the total. These sectors carry high capital costs, low margins, and heavy dependence on cross-continental supply chains, particularly industrial inputs, metals, and components from China. With Trump's 100% tariff on Beijing, input costs surged while European exporters faced potential 10–15% tariffs from the U.S. manufacturers in Germany. Italy and Spain faced a double whammy: rising input costs, restricted market access. The auto industry, already struggling in the transition to EVs, became a focal point. A mere 10% tariff could slash exports to the U.S. by over 15 billion euros annually, with ripple effects through machinery and pharmaceuticals, totaling potential losses exceeding 50 billion euros in the first year. Recently, Europe has faced a growing crisis: chronic drug shortages. The European Court of Auditors, ECA, has identified a fragile supply chain and an over-reliance on Asian manufacturers, particularly for essential medications like antibiotics and painkillers, as the main culprits. The ECA warns that the situation is becoming increasingly dire, with costs rising sharply. The imposition of tariffs, they caution, will only exacerbate the problem, further driving up the cost of acquiring these vital drugs. Trump's tariff salvo shook more than industry. It rattled the euro. Eurozone economic confidence in October fell more than 4 points, the lowest since 2023, while Frankfurt's DAX index lost 5% over 3 weeks, reflecting growing investor anxiety over a potentially protracted trade war. Global financial markets responded immediately. Major investment funds, including Allianz, AXA, and BlackRock Europe, pulled capital from industrial stocks, shifting toward energy, defense, and gold. Rotterdam and Hamburg ports reported container volumes to the U.S. dropping nearly 8% in just 2 weeks. If the trend continues, Europe could face a new trade winter similar to 2019, but with far less resilience. Ironically, while Trump taxes to protect America and China, retaliates to protect national interests, Europe, innocent in initiating conflict, becomes the collateral victim caught between two tariff walls. As the losses mount, Brussels is left with one pressing question: if both the US and China shut trade doors, where does Europe stand? Stick with Washington and risk dependence, or open eastward to carve a new path? So is Europe pivoting toward China. Since late 2024, the EU has embraced the concept of de-risking, reducing dependence without severing ties. Brussels understands that China is not just the world's factory, it is a major consumer market for European industries. In 2024, China imported nearly 70 billion euros in goods from the EU, with Germany, France, and Italy accounting for over half. Corporations like Volkswagen, Airbus, L'Oreal, and Siemens view China as inseparable from their global value chains. As a result, rather than retreating, many European companies are deepening investments in China to safeguard competitiveness. Rhodium Group data shows EU direct investment in China rose 12% in Q3 2025 year over year, the first growth since the pandemic. But this pivot is not just corporate. Politically, Brussels is sending subtle signals. In a speech on October 8, 2025, just days before Trump signed the 100% China tariff, von der Leyen described the EU-China relationship as one of the most complex and important in the world, stressing that dialogue is the only path to reducing tension. A leaked EU Commission draft obtained by Politico Europe referenced a flexible trade strategy, indicating Europe would avoid joining confrontational economic blocs against Beijing. In other words, the EU seeks a middle ground position, not fully aligned with the US, but not wholly dependent on China either. At the same time, Europe cannot ignore the risks. The 2022 energy shock and the 2024 anti-dumping investigation on Chinese EVs have shown that economic dependence can quickly translate into political constraint. Brussels is attempting a delicate balance between trade cooperation and strategic security. The EU's upcoming 2026 policy will focus on three pillars: supply chain diversification, outbound investment controls, and strengthening bilateral trade deals with India, ASEAN, and Africa, aimed at preventing over-reliance on either Washington or Beijing. Still, no region can replace China in the short term. Even in strategic sectors, batteries, renewable energy, rare materials, China controls over 60% of the global value chain. Meanwhile, US tariffs favor domestic production, making it hard for European goods to compete. Pragmatically, Brussels must pick a partner to minimize exposure to US tariffs. China, risky though it may be, emerges as the lesser pain. Yet the bigger question goes beyond trade. If the tariff war persists, it will reshape not only the flow of goods, but the very architecture of global power. Europe, once the central ally of the West, may slide into the role of a third party, not strong enough to dictate the rules, yet not weak enough to be swept aside. Analysts call this period the EU's gray zone, no longer fully aligned with the US, not yet ready to stand shoulder to shoulder with China.